When planning for distributions from an employee stock ownership plan, it's also vitally important to understand the tax implications to avoid costly surprises and to maximize your goal for after-tax retirement income. I'm Peter Newman, the founder and president of Peak Wealth Planning. We specialize in managing the retirement income portfolios of ESOP participants that are close to diversification age and retirement. In most cases, employee stock ownership plan distributions are taxed as ordinary income in the year you receive them. This applies whether you take your payout as cash or company shares. However, if you receive a lump sum distribution in the form of company stock that represents the entire balance of your ESOP account, the tax rules become more nuanced, and this is where people miss important opportunities. You'll pay ordinary tax on the value of company contributions to your account, but here's the key advantage. You could pay capital gains tax, often at lower income tax rates, on any appreciation in share value when you eventually sell the stock. This is called Net Unrealized Appreciation, or NUA, and it can provide significant tax savings for those who understand how to use it. You'll also need a letter from your company stating the value of their contributions to your account to take advantage of NUA. Make sure your company can provide that letter to you. To defer taxes and maintain control over your retirement timeline, you may be able to roll your employee stock ownership plan distribution, whether cash or shares, into an IRA or another qualified retirement plan. To defer taxes and maintain control over your retirement timeline, you may be able to roll your employee stock ownership plan distribution into an individual retirement account or another qualified retirement plan. This decision becomes crucial when designing a portfolio to turn your ESOP wealth into a stable retirement paycheck. Rolling over to a traditional IRA allows you to postpone and control when you pay taxes at the time you start withdrawing funds. Those taxes are paid as ordinary income tax. If the distribution check you receive is written to you directly, you only have 60 days to complete a rollover to an IRA or a 401k account, or else the entire amount becomes taxable in 1 year, could force you into a higher tax bracket, and if you're below age 59 and a half, could also result in an early withdrawal penalty of 10%. It's important to be aware of these tax rules and your diversification and rollover options. Successfully integrating your ESOP into a comprehensive retirement strategy requires careful attention to multiple areas. Understanding the mechanics, timing, and diversification rules ensures you can access your benefits when needed while taking advantage of strategic diversification opportunities. The tax considerations for ESOP distributions can significantly impact your retirement income, making it essential to understand your rollover options and required minimum distribution planning. Transforming your concentrated ESOP wealth into the goal of reliable retirement income involves navigating complex rules, timing decisions, and tax implications. If you're approaching ESOP diversification eligibility or planning your retirement strategy, it's worth considering professional guidance to develop a personalized roadmap that aligns your ESOP benefits with your retirement goals. Subscribe to this channel to stay up to date on everything you need to know about ESOPs. Schedule a free consultation with us to discuss your specific situation.